Railroad Accounting Principles Final Report, Volume 1, Summary of the Report. Railroad Accounting Principle Board. The Railroad Accounting Principle Board is Charles A. Boucher, Comptroller General, United States Chairman Charles W. Bath, Vice President, Traffic, Farmland Industries Incorporated, Merton J. Peck, Professor of Economics at Yale University, Richard E. Richard E. Briggs, Executive Vice President, Association of American Railroads, Gordon Schilling Law Professor of Accounting at Columbia University, Jack L. Mayheffy, President of Shell Mining Company, Reynolds S. Young, Director of Bureau and Accountants, Interstate Commerce Commission. Acknowledgement. The board member which condemned the staff of the Railroad Accounting Principal Board for the professional dedication to achieving the Railroad Accounting Principal Board objectives. The support was essential to the completion of the Railroad Accounting Principal Board mission. Charles B. R. Yeager, Executive Director, Kurt V. Fester, Deputy Director, Jeffrey A. Jacobson, General Counsel, John A. McQuad, Deputy Director through 31 through 87, Michael K. Turca, Michele, K. Turkey, Administrative Assistants, Randall G. Garber, Deputy Director, John L. R. Riley, Franklin P. Rexford, Manager, Joanna G. Kaufman, Accounting Author, T. Ferna Economic Association, Denise C. Jones, Senior Secretary, Betty J. Smith, Secretary, and Lynn M. Harding, Secretary. The board also wishes to thank Milton J. Sockler, Arthur Schoenhott, Ryan Abel, and others general and accounting offices that support the Board of Activities. Volume 1. Abbreviations, Introduction, Legislative Background, Specific Regulatory Application, General Purpose and Cost Systems. That is the introduction, 1 through 5. Pages 1 through 5. Chapter 1, Railroad Accounting Principles, Casualties, Homogeneity, Practical Data Integrity, and Etny, Cost of Capital, Assess Valuation Related Expenses, Productivity, Effective Principles of Specific Regulatory Applications in Chapter 2. Application General Purposes and Cost System, Revenue Adequacy, Maximum Rate, Competitive Access, Abandonment, Subcharge, Minimum Rate, Long Canon, Factor, Rail Cost Adjustments Factor, General Purpose Cost Systems. Chapter 3, Effects of Principal Existing Interstate Commerce Committee Practices, All Regulatory Applications, Specific Regulatory Applications, General Purposes, Costing Systems, Statements of Individual Boards, page 35, and we're going to start in a second. The abbreviations are the AICP, American Institute of Certified Public Accounting, the GAAP, General Accepted Accounting Principles, GPCS, General Purpose Costing Systems, ICC, Interstate Commerce Commission, R1, Railroad Annual Report Form R1, RAPB, Railroad Accounting Principal Board, RCAF, Railroad Cost Adjustment Factor, RFA, Rail Form A, Statements of Auditing Standards, SAS, SRA, Staggers of Rail Act of 1980, USOA, Uniform System of Accounts, URCS, Uniform Costing System, 4R Act, Railroad Realization Regulatory Reform Act of 1976. The introduction. In accordance with the congressional mandate of the Railroad Accounting Principles of the RAPB, has established 8 railroad accounting principles to govern the determination of the cost of specific regulatory purposes. The Railroad Accounting Principle Board describes those principles that are applicant in this document. Volume 1, identifies the principal brief that discusses the regulatory circumstances in which the principle will apply, outlines the effects of the principles they are intended to have on the existing Interstate Commerce Commission and practices. Volume 2 discusses the matter in greater deal and explains the main alternative principles considered by the Railroad Accounting Principle Board during its deliberations and factors which have contributed to the conclusion reached by the Railroad Accounting Principle Board. The legislative background. The Railroad Realization Regulatory Reform Act of 1976, 4R Act, was enacted by the Congress to improve the financial viability of the nation's railroad. The legislation made a number of the sweeping changes to the regulatory railroad regulatory environment emphasizes the need of the Interstate Commerce Commission to use more accurate accounting of the cost data. In response to the needs of the Interstate Commerce Commission, revised and expanded its prescribed regulatory accounting system, the Uniform System of Accounts (USOA), in 1978. The Interstate Commerce Commission also began a program in place of the existing Rail Form Act (RFA) costing systems with a more sophisticated Uniform Costing System, the URCS. The Railroad Form Act and the Uniform Rail Costing Systems accounting the allocating systems that statistically techniques that generated variable units of the annual expenses operating information reported by the Interstate Commerce Commission. The Rail Form Act was originally developed in 1939 using the USOA, or Uniform System of Accounts, developed in 1907. Understanding statistically studies were last updated in 1972. The URCS, the Uniform Cost System, which has not yet been approved by the regulatory costing purposes, that has its rights to revise expanding the USOA. Statistical studies completed in 1982, the URC is designed to facilitate more frequently updated than statistical studies. The Staggers Rail Act of 1980, SRA, further reduced the scope of the rail regulation. It intended to provide the railroad industry additional incentives, ensuring the railroad's long-term viability, with attempting to balance the needs for carriers, shippers, and the public of the competition does not exist. Certain important issues dealing with the determination were left unresolved of the SRA Staggers Railway Act. This issue long has been basis of disagreement with shippers and railroad. The Railroad Accounting Principle Board was created by the Staggers Rail Act of 1980. It was funded in 1984 to establish a body of cost and accounting principles to serve a framework implementation regulatory provisions which cost and determination plays a vital role to make administrative legislative recommendations that it deems necessary to integrate principles of regulatory process. According to the Staggered Rail Act, an Interstate Commerce Commission must implement and enforce the Railroad Accounting Principle Board principles through rulemaking principles which will afford interested parties opportunities to participate. Because the Interstate Commerce Commission is ultimately responsible for the cost of the principles, it must review the principle in the light of the rulemaking comments from the interested party, reasonably explain its rules, adopts, and however, as part of the rulemaking process, the Interstate Commerce Commission must accordingly substantiate differences of Railroad Act Principles Board. Principles to the rationally underlying the principles. During the past 2 to 1.5 years, the Railroad Accounting Principle has been considered various issues, proposed principles relying on staff research, legal counsel, consultation, interstate commerce proceedings, and public comment of the Railroad Accounting Principle Board. Published in notice in February 20th, 1985. Federal registers inviting the public to comment on the issues the Railroad Accounting Principle Board should address. The Railroad Accounting Principle Board should be published at notice of January 31st, 1986. Federal registers inviting the public to comment on the proposed solutions of the serious issues, questions contained in the Railroad Accounting Principle Board. Discussion memorandum. The Railroad Accounting Principle Board published a notice in the February 20th, 1987 Federal Register inviting the public to comment on the written proposed principles recommendations contained in the Railroad Accounting Principle Board. Exposure to the draft of this report. Finally, the Railroad Principle Board had a public hearing of the proposed principles of April 30th, 1987 in Washington, D.C., at which the interested parties appeared to present oral statements. Specifically, regulatory applications. The Railroad Accounting Principle was provided with the framework determining the railroad cost-specific regulatory applications. The primary apply to the primary Class 1 railroads that affiliated with the Class 2 and Class 3 railroads, other railroad-related affiliates. However, the Interstate Commerce Commission requires that the Class 2 and Class 3 railroads provide information like the provided by the Class 1 railroads. Specific regulatory purposes of the principle also who would apply. The Railroad Accounting Principles do not provide guidance in every regulatory determination the Interstate Commerce Commission must address. For example, they do not address allocations or appropriatements of burden. They do not depend on regulatory policy of objectives. The Staggered Rail Act provides the Railroad Accounting Principle Board take into account of the specific railroad purposes of the railroad cost as required. During the railroad application Railroad Accounting Principle Board deliberations should commentary argued by the Staggered Railroad Act did not grant the Railroad Accounting Principal Board jurisdiction to provide the certain principles applications covered in this report. The Railroad Accounting Principal Board has determined that the principles of the application provided herein and are fully within the scope of the statutory and mandatory supporting options of the Council may be found in Volume 2, Appendix. Specific regulatory applications addressed by the Railroad Accounting Principles are as described below. The revenue adequacy. In the Interstate Commerce Commission is required to determine an annual whether individual railroads generate revenues that adequately to cover total operating expenses and costs of capital. The railroads that are revenue adequate are subject to the greater regulatory control than those that are not. The regulatory standards adopt the Interstate Commerce Commission to pressure the revenue adequacy whether the return of the investment equals the cost of the capital. The Railroad Accounting Principal Board has focused in its efforts to the cost elements of regulatory standard, not regulatory policy issues of the appropriate standard determining the revenue of adequacy. The maximum rate. Railroads may not charge a captive shipper a rate exceeding the reasonable maximum level. One of the factors of the Interstate Commerce Commission presents to consider determining whether the rate is responsible is its relationship to the cost. The Interstate Commerce Commission considers a rate of large movements of the coal to be unreasonable if exceeding the cost of the hypothetical new competitor which would incur to provide the needs services of the captive shippers or other designated shippers. The costs are referred to as standalone costs. However, the maximum rate reasonable proceeding on the large movements of coal of the Interstate Commerce Commission have accepted cost evidence based on other methodologies and has proposed regulatory standards other than standalone costs. The Railroad Accounting Principal Board has focused its efforts on the standalone costs without addressing whether its appropriate regulatory cost standards of the maximum rate responsible reasonableness in rate reasonableness cases. Competitive access. The Interstate Commerce Commission may establish reasonable rates that one railroad may charge another railroad for providing switching services for using its tracks. In addition, with considering the cost of the railroad providing access, the Interstate Commerce Commission also considers other factors. Joint rate, route cancellation are sometimes considered within the purview of the competitive access. However, the variable costs in such cases typically developed in the General Purposes Costing System, the GPCS. General Purposes Costing System, GPCS, are subject to the movement specific adjustment, do not require separate specific application consideration. An abandonment or a surcharge. A railroad may be allowed to abandon a branch line or add a surcharge to the shipments to and from the branch line if the railroad is earning insufficient revenue from the line. According to the President Interstate Commerce Commission, standard branch line revenues are sufficient if they exceed the cost could be avoided by the railroad if they do not have to serve the branch line in question, including the opportunity costs associated with the maintaining services, the portion of the railroad not branch of the variable costs associated with the shipments originating in the termination of the branch line. Minimum rate long-term canon factors. The ICC, the Interstate Commerce Commission, prohibits railroads from setting rates at the reasonably minimum level of the Interstate Commerce Commission that has been determined to be equal directly variable costs, although the Interstate Commerce Commission is required to consider three factors known as the long canon factors. The determination whether the rate exceeds reasonable maximum level. Traffic does not contribute to the going concern value. Traffic on which the revenues can be increased, traffic of the paying an unreasonable share of revenue. Those three, once again, were traffic which does not contribute to going concern value, traffic on which revenues can be increased, and three, traffic paying unreasonable shares of revenue. The Railroad Accounting Principal Board addresses only the Interstate Commerce Commission minimum rate reasonable requirement. For the first long canon factor in the determination minimum costs which must be recovered to the contribute giving going concern value. Both of these determinations use the same cost. Two remaining long canon involve the management, pricing, efficiency, crossing, subsidizing, consideration where the role of the cost is not clearly defined in the current Interstate Commerce Commission. Subsequently references the minimum rate long canon factor pertaining only to the first of the three long canon factors. A rail cost adjustment. Rails are permitted to recover inflationary cost increase of the minimum regulatory involvement with index tariff rates. These recoveries such costs are using index known as a railroad cost adjustment factor, the RCAF. The railroad cost adjustment factor currently is computed using the forecast index of the industry-wide input prices compromised by labor, fuel, materials, supplies, equipment, rents, depreciation, and other expenses. The general purpose of costing systems. The Interstate Commerce Commission, using general purpose cost of regulatory devices, estimates the variable costs that you use in certain specific regulatory applications. For example, the Interstate Commerce Commission has regulatory jurisdiction only over traffic whose tariff rates compared on a percentage basis of the carrying railroad's variable cost of the traffic. Exceeding the statutory threshold, the statutory requires the use of general GPCS to calculate the variable cost. The GPCS, or once again, GPCS, the general purpose cost system, may be used to estimate elements of movement costs and other proceedings such as involvement, maximum rate, competitive access, abandonment, surcharge when there are more details approaching not justified. The general purchase cost system reported expenses are related to the reported output, applying the regression equations such as those used in the Railroad Form A Act. This URCS, the expenses are aggregated, reconciled. The reported operating expenses determined that using the General Accepted Accounting Principles (GAAP). However, the cost of the capital amount of the computed included the estimated rates of variability. The variable costs are used to compute the variable unit cost of output. The variable unit costs are multiplied by the appropriate measures of output called service units for the movements involved. Chapter 1: Railroad Accounting Principles.